Have you ever tried to read a company's financial report? I mean, really read it? It can feel like you're trying to learn a whole new language, right? But what if I told you there's a simple way to crack the code? Yeah. In just the next few minutes, we're going to give you the keys to unlock the real story that's hidden inside all those numbers.
Yeah, we've all been there. You open up one of these things and bam, you're just hit with this wall of dense text, complicated tables, and all these official-looking stamps. Honestly, it can feel like it's designed to be confusing, but I promise you, it's telling a really, really important story.
And that's exactly what we're going to do here. We're going to forget about reading every single line. Nah. We're going to learn how to spot the clues, how to read between the lines, and how to quickly figure out what really matters, how a company is performing and, its overall financial health. So here's our game plan. First, we'll crack the corporate code. That's the official announcement. Then, we'll look for the auditor's green light. After that, we'll dive into the profit statement and the three numbers that matter most. Then we'll dig into the fine print. That's where the secrets are. And we'll finish up by checking out the company's overall financial health. Sound good? Let's go.
Okay, so every single report kicks off with this formal letter. Now, it might look like just a bunch of boring standard text, but it actually sets a super important piece of context. Right, so this isn't just some memo floating around the office. This is a formal, legally required document. It's sent to the stock exchanges, which means it's sent to the entire investing public. This is the company, on the record, telling everyone how they did. No hiding. But before we even glance at a single number, we have to ask a big question. Can we even trust what we're about to read? Well, that's where the independent auditors come in. Think of them like the referees in a game. They're the third party that comes in to check the company's work and make sure everything's fair. And in this case, for this report, you can see two well-known firms have signed off on it, Pricewaterhouse and Kirtan and Pandit. I mean, they are literally putting their names and their professional reputations on the line here, vouching for the accuracy of these numbers.
Now, you might see this term limited review and think, wait, limited? Did they cut corners? Don't worry, this doesn't mean they did a lazy job. It's actually the standard level of review for a quarterly report. A full deep dive audit is this massive, massive project that companies usually only do once a year. Okay, this is the magic phrase you're looking for. It sounds kind of weak, right? Full of legal speak, nothing has come to our attention that causes us to believe. But in the world of accounting, this is the all-clear signal. It's the auditors basically saying, hey, we've reviewed the books, and from what we can see, everything looks right. This is your green light.
All right, we've got the auditor's stamp of approval, so now let's get to the main event, the statement of profit and loss. Now we're going to ignore all the noise and just focus on three key lines that, honestly, tell you about 90% of the story. First up, the top line, total income. For this quarter, that's over 18,000 crore. Just think of this like your total household salary, before you pay any bills. It's all the money that came in the door from interest, fees, you name it. And next, of course, is what went out the door, total expenses. This is what it costs the company to make that income. We're talking about everything from finance costs and paying employees to setting aside money for loans that might go bad.
And here we go. The bottom line. The number everyone looks for. You take the income, you subtract all the expenses and the taxes, and this is what's left. The profit after tax. Over 4,500 crore. This is the real deal, the actual profit the company pocketed.
But what's really cool is when you put this number in context. A single number by itself, it doesn't tell you a whole lot. But a trend tells you everything. And this chart shows a really positive story. You can clearly see profit has been growing, not just from the same time last year, but even from the last quarter. That's a sign of some really healthy momentum.
But wait a second, did that big profit number get a little extra help this quarter? See, the big numbers are the headline, but the fine print, what they call the notes section, that's where you find the real story.
So we're going to jump straight to a specific section in the report called Note 6, Exceptional Items. I mean, the name itself is a clue, right? This is where companies have to tell you about things that are unusual, stuff that's outside of their normal day-to-day business. And boom, look what we find. Two huge one-off events. On one hand, the company had a massive gain, over 1,400 crore, from selling off some shares in another company. But on the other hand, they also took a 250 crore hit because of new labor laws. See, these aren't part of the regular business, but they had a huge impact on that final profit number. This is absolutely crucial context.
Okay, so we've looked at performance, but what about the company's overall health?
Well, financial ratios are kind of like a quick checkup with your doctor. They give us a snapshot of the company's stability and how much risk it's carrying. First up is a big one, the debt-to-equity ratio. The report tells us it's 3.13. So, what on earth does that actually mean?
Well, it's basically a measure of leverage. It tells us that for every 1 rupee of the owner's own money, that's the equity, the company has borrowed 3.13 rupees. Now, for a finance company whose whole business is borrowing and lending, a higher ratio like this is pretty normal, but you still want to watch it because it tells you exactly how much risk the company is taking on.
All right, next up is a ratio that is absolutely critical for any lending business, the gross NPA ratio, which is sitting at 1.56%. So what are NPAs? Well, this just means that 1.56% of the company's total loans are non-performing. In plain English, the people who took out those loans have stopped paying them back. So you always want to see this number as low as possible, because it's a direct measure of how good the company's loan portfolio is.
And there you have it, your very own toolkit for cracking any financial report you come across. So let's recap. 1. Always start with the auditor's report to get that green light. 2. Check the profit statement for income, expenses, and that all-important bottom line. 3. Dive into the notes to find any exceptional stories. And 4. Analyze a few key ratios to see the big picture of the company's health.
So these documents, they're not intimidating walls of text anymore, are they? They're basically report cards, each one telling a story about a business. And now that you know the language, you have the power to read and understand that story for yourself. The only question left is, what story will you uncover in the next one you see?